Over the past decade, QQQ has achieved remarkable performance with a gain of over 435%, while VGT has outperformed QQQ with an impressive 555% return. In comparison, the S&P 500 has risen by 250% during the same period. And SCHD has also posted solid returns with over 207% increase, but it trails significantly behind QQQ and VGT. And as investors, we've been benefiting from a bull market largely due to tech giants like Nvidia, Meta, Google, and Microsoft. And these companies are not only heavily represented in growth-focused ETFs like QQQ and VGT, but also account for a substantial portion of the S&P 500. And this is the main driver of the robust performance of those funds, right? But the most important question you can ask yourself at this moment is, how long will this continue? In this video, we will discuss the potential market shift in 2025 and why ETFs like SCHD will outperform growth ETFs like QQQ over the next decade. We will explore why value stocks are generally seen as more stable with lower volatility and higher dividends compared to growth ETFs, and how you can position yourself to benefit from this shift. Because let's be honest, as investors, we are all chasing the best possible returns. It's human nature. We see the big money moving and we just want to get in. Just like back in 2000, during the dot-com bubble, tech stocks were on fire, delivering huge gains year after year, and everyone wanted a piece of it. And now we are doing the same, looking at sites like Morningstar to see which funds are outperforming and trying to follow the trail. But after being in the financial industry for so long, I've learned an important lesson. You don't want to chase after the best performing funds. If you are looking to build a solid portfolio, focusing too much on historical performances can be a trap because markets run in cycles, and what's hot today might not be tomorrow. And that's why, after years of a bull market dominated by tech, I believe we will see a turning point at some time soon. But don't just take my word for it. Let's hear from one of the greatest minds in investing, Jack Bogle. Bogle, the founder of Vanguard and the pioneer of index investing, always emphasized the importance of avoiding the temptation to chase returns. He famously said, "The biggest mistake investors make is looking backward at performance and thinking it will recur in the future."
What goes up must go down. And in the financial markets, it really works. I have an example in the book. The point of all this, Jim, is don't buy funds on the basis of past performance because it's not going to continue, or it's only the extraordinary case when it's going to continue. So people tend to, as I mentioned earlier, put their money into these big winners, and then down it goes. They pick the high because that's when the fund looks the best. So in that part of my recommendations, recommendation one, I've taken 8 of the best known and most successful mutual funds of the modern era, and I've charted their return year after year cumulatively against the S&P, the Standard & Poor's 500 index. And every fund looks the same, although all the time periods are different. The fund goes like this, and then it goes like this. This, over and over and over again. And you see this in the big winners of the age, and they go away, their managers leave, even the good managers might get fired, the bad ones retire. There just doesn't seem to be any permanent way to beat the stock market. It's all fads, fashions, particular time periods. You know, when, for example, growth does better than value, you want to put your money in a growth fund, and then value does better than growth. Well, these 10 funds, which I list by name in the book, and 2 of them are Vanguard funds, in fairness. This book is an attempt to be really honest, no matter how painful, and you see that same pattern over and over again. So when you say, I ought to buy this fund, I can tell you where you are on that line, right at the peak. And when the temptation is overwhelming, you put your money in and then are disappointed thereafter.
So why do I think SCHD will outperform growth ETFs like QQQ and VGT? Let me explain, because it's really important that you get this. it's crucial to understand that the short-term performance of growth or value stocks is heavily influenced by the current market cycle. We have experienced an extended bull market that has benefited tech and growth stocks, but there are clear signs pointing to a potential market and economic slowdown in the US over the next 1 to 3 years. As we have recently discussed this on this channel, one of the most important key indicators is the Federal Reserve decision to cut rates, beginning with a substantial 0.5% reduction. And we all know that the size of this cut clearly signals a serious economic slowdown, right? And many investors are concerned that without such a drastic measure, we would likely to be on the brink of a recession. Even with these rate cuts in place, numerous analysts are still predicting a mild recession in 2025. And additionally, the US credit card and consumer debt is at an all-time high, which points to a slowdown in consumer spending, an indicator that typically signals an impending recession. So, this rising debt level suggests that consumers may be stretching their finances, leading to decreased spending, which can further intensify economic challenges and contribute to a downturn. And what I have learned is that a significant advantage of value stocks is their tendency to be less volatile compared to growth stocks. And this characteristic makes them appealing to conservative investors or those looking for stability in their portfolios. And therefore, many retirees face a significant challenge. They seek stable income to support their lifestyle, which typically leads them to invest in bonds for safety, right? However, over the last decade, low interest rates have resulted in bonds underperformances. For example, BND from Vanguard did an annual 1.8% return over the last 10 years, making them less appealing to investors. And we all know that as interest rates decline, those returns are expected to drop down further. And therefore, investors are more likely to turn their money into the stock market in search of safer, low volatility funds that still provides cash flow through dividends, because they need a steady income in this phase of their lives. And therefore, what a lot of investors don't know is that many studies point to value investing outperforming growth over long periods of time. Looking at recent data, value outperformed during the first 10 years of the 2000s, what is kind of logical, and growth dominated in the last 10 years. But the most important part is that dividends likely played a key role in helping value outperform over longer periods of time. And therefore, value stocks are often associated with established companies that have a history of steady earnings and sound financial practices. This stability can help cushion investors during market downturns when growth stocks may experience sharp price fluctuations. And this is why I believe value stocks and ETFs like SCHD will perform well in the coming years. Value stocks tend to outperform during bear markets and economic recessions, while growth stocks thrive during bull markets and periods of economic expansion. And like I've said before, we saw the same pattern in early 2000s after the dot-com bubble burst, when tech and growth stocks experienced a sharp decline. But value stocks helped sustain the market, and these were the place where the real profits were made. And the next few years could mirror that same scenario, right? And that's the reason why SCHD is high on my list, because SCHD primarily consists of large cap value stocks which may be considered more stable but less exciting. And these include sustainable companies like Home Depot, Bristol Myers, BlackRock, Verizon, and Cisco. And SCHD also offers good diversification across various sectors, including financial healthcare and consumer staples. And guess what? Sectors like healthcare and consumer staples are often viewed as robust during economic fluctuations. Despite this, SCHD has delivered impressive overall performance, boosting an annual return of 11.7% over the last decade. And this makes SCHD an excellent choice for those seeking to balance stability with income generation. And next week, SCHD is having a significant ETF split. generating buzz at this moment around this fund. And therefore, it's a front runner for investors looking for a stable, dividend paying, and lower volatility investment. And what I see in the market is that many investors who have profited from tech stocks are now considering reallocating their gains into something more sustainable and more secure, like SCHD. So, what I always emphasize to my clients and what I want to share with you as well is the importance of diversification, staying calm, and having a solid plan that aligns with your personal financial situation for the future. Markets will go through various phases, and it's essential to prepare yourself accordingly. So, if you are curious about my top 3 fund portfolio designed for navigating these market cycles, be sure to watch this video where I explain the strategy in detail. I would love to hear from you and let me know in the comments below where you currently investing. See you in the next video.